As Ish has kindly pointed out, I'm sort of the dummy in the room here to learn, so you'll have to excuse my stupid questions. And I don't need to introduce you. Ish has done that. You guys probably know what Delphi does, but just to start us off, tell me how you got involved in this. I think the college dropout story is always popular.
So we're a team of 4 people from CMU. We all studied AI or CS, and we dropped out just a few months ago. We have a really interesting founding story. We actually all met playing poker. So for those poker players out there, we were at the tables like hours and hours, like basically every day, and just became really close, started building in prediction markets, and have been trading for the past 2 to 2.5 years. And around like October or November, we realized this like gaping opportunity building infrastructure in the space. And we just started building. We packaged up all of our trading infrastructure and our data, and we started selling it to traders. And we got some pretty quick traction, but we had no funding. And so we actually put ourselves into almost like 30 grand of like credit card debt just trying to sustain ourselves. And the reason we know our product is the best in the market is because we're our number one customers. So in order to get ourselves out of this credit card debt, we actually just traded on prediction markets and got ourselves back to ground zero. And then we got some investments, and now we're here, and this is why we're alive.
Great. I mean, you hear so much about students getting involved in prediction markets. I know I'm not American, but I hear that in fraternities it's very common to do sort of sports betting. Tell me about the role of students. I mean, how big a deal are prediction markets if you're a young guy at university right now?
It's really interesting because there was, so fraternity is obviously like young men, they love like sports betting, prediction markets are obviously that whole spiel. Around the time of the Super Bowl, there was a really interesting phenomena that happened. Like I witnessed it with all of my friends. Basically, some fraternity, I think in like Clemson, or I don't know what university, started spreading, their family friend was an event director, event coordinator at the Super Bowl, and they knew the exact song that Bad Bunny was going to play first. That market, we caught this on Delphi, was doing like loads of volume. It was spiking up and down. There was so many different songs that apparently their friend's mom's cousin knew was going to be the first song, and then at some point during the Super Bowl, for those of you that were trading on that market, we saw that photo of Mark Wahlberg come out, and every fraternity in the US fell victim to this like epidemic. So I know a lot of fraternities that bet all of their dues, all of their funds, and lost all of it. At Carnegie Mellon, we thought something was up when like 5 different people had like 5 different mom's cousins being event coordinators at the Super Bowl, saying different things, and so we were like, okay, this is obvious. So we just shorted everything. But yeah, I think there's some really interesting stuff about insider trading or just like word of mouth, like especially in fraternities in the U.S.
And so you guys start this company. I mean, explain to us exactly what Delphi does.
So we started Delphi as traders, and so naturally we started integrating our data and our infrastructures to like market makers and prediction market traders. And we got some pretty quick traction, and we signed some pretty big quant funds that were either market making in prediction markets or market making on other asset classes that use prediction markets as a signal. And we slowly pivoted more and more towards the institutional side. So now we help institutions price, hedge, and trade on global events.
What's the goal with this? I mean, people, normally have a grand vision when they drop out of uni for something. What is the end goal?
It's a really good question. Our mission here at Delphi is not the mission of a lot of other prediction market companies. We believe in the idea of a riskless society. So a riskless society is a society in which every rational agent can hedge their decisions, and this is now possible with event contracts. In society today, the actions of few impact so many. Think of the Iran crisis right now. Oil and gas prices all around the world are spiking because of what's going on in the Middle East. However, in a riskless society with these event contracts, the oil economy can now perfectly hedge themselves so that the decisions of so few doesn't impact the masses. There's no trickle-down effect to consumers. Think about like supply chain risks, like just an import-export company or a manufacturing company, if they have a supply chain risk that is unhedged, they lose a lot of money. Do they take that loss themselves? On most cases, no. They offload that cost onto the consumer, and we all get impacted. In a riskless society, they are able to hedge that risk perfectly, and consumers don't get impacted. This is not possible with event contracts.
Is there a particular question you guys have worked on with your data and all your sort of quant work that stands out?
I think the most recent one that we've done is we're working with a couple of policy firms in DC, and you're from England, so we had a policy fund that had a pretty big trade on British gilts, British bonds, and obviously there's been a lot of forecasting and a lot of analysis, a lot of polling done on the May 7th elections. For those of you that don't know, there are like 170-something local elections happening all around the United Kingdom, and that will greatly impact Keir Starmer's chances of staying in office, which will then impact British gilts. And what people weren't contextualizing and doing analysis on was how the Iran crisis was going to affect the common people of the United Kingdom and how they would vote labor or not labor. And so what we were able to do is help the policy firm, the policy fund, determine what the impact of the Iran crisis was going to be on the United Kingdom, and therefore the Keir Starmer going to be out market to help them influence their trading.
To be clear, are they using prediction markets as an informational tool, or are they actually hedging using prediction markets?
So right now, they're using it as an informational tool. I think you'll see in the next few months, next few years, that you can start using prediction markets as a hedging tool. And this is something kind of revolutionary, right? Like I worked at a hedge fund before, and people spend like hours and days like building giant portfolios to represent will Keir Starmer like be out of office to then hedge themselves on their British bond trade. That is so unnecessary right now because you have something like prediction markets where instead of 30 assets, you have one asset which you can hedge properly on.
What will it take for this to become a hedging tool? Is it a question of volumes, liquidity? Is it regulation? I mean, I see a lot of rules issues popping up. If you're putting billions on a trade, you probably don't want it to fall down on a rules issue.
So I think the rules issue is interesting. As a prediction market trader, obviously rules are very important, but I think that's just a learning curve that's more educational than anything. The top prediction market exchanges have gotten better at improving their rules and their rule systems. And the first thing all prediction market traders know to do before they trade on a market is just read the rules. It's very important. I think the second thing for this to be possible, for this riskless society to be possible, is liquidity in the market. You can't pour billions into a market when there's $5,000 of open interest. So liquidity is the next step, and that just comes with more education and more institutions just adopting this technology.
What are the biggest barriers to that happening right now? Because with Kalshi, we've got past the CFTC regulation. Even the fact that we're all here, we can see public sentiment turning towards, oh, maybe we should all try this. What do you need for this thing to scale?
I think that's a bit of a chicken and egg problem, right? Like the first thing they teach you about like B2B marketing is like you have to show that you have like a giant enterprise customer to then sign a giant enterprise customer. And this is very similar, right? Like when you go to an institution, you need to have other institutions trading before more institutions come in. I think it just comes, like the dominoes will fall very quickly, and once the first one comes, the rest will naturally fall in line. It's just a matter of liquidity and one firm taking a leap of faith. And a lot of that is just education.
It's interesting because you're helping institutions get involved in the market. I mean, I assume there's a lot of individual traders here who don't really want institutions to get involved, right? I mean, it's going to make it harder to make money. How do you square those two things, the sort of individual whale who's currently doing quite well on these markets, and if you get a bunch of institutions coming in and pouring in money, does that reduce the opportunity for other people?
Actually, I was just speaking to, I forget who it was, but I was speaking to someone about this exact question, and I think their answer was really, really well thought out. As more and more institutions come into the market, obviously like liquidity and open interest, all of this increases. So yes, their edge goes away significantly, but because open interest increases a lot, even though their edge is smaller, the amount of money they can make off a smaller edge is actually greater. So it kind of evens itself out. Also, I think as more institutions come into the market, you'll start seeing more and more interesting markets. Like, I think there's a really beautiful thing about prediction markets. If you think about the history of asset classes and the history of, like, think about stocks. Like, I'm sure there's like 3,000 to 5,000 base, like, assets in the tradable universe. When you go to options, you go up by a magnitude of 10. There's 30,000 to 50,000 tradable assets in that universe. Prediction markets are the most beautiful asset class because there are an infinite number of tradable assets. Every difference of opinion is now a tradable asset in the universe. Like we see in our own like servers, there are tens of thousands of new markets getting added to each exchange every single day. And that number will only keep increasing. I think it's very beautiful.
When you look at the questions that these platforms are asking, to me, that's sort of the power they have. They get to decide which questions. And we saw, Kalshi partnering with ARK Invest. So clearly investors want the power to pose these questions. Do you think they're asking the right questions? Is it possible to have too many questions on there? As you say, it is an infinite thing. If you have loads of thin markets, is that useful for your riskless society?
So right now, I think markets on prediction markets sort of follow a power law. Like there are a certain few markets that have basically all the volume and everything else just takes the tail end. In terms of the riskless society, I think right now they're asking some of the right questions, but it's just like basic like supply and demand. Those institutions will then, like Kalshi is incentivized to ask the right questions, put the right questions on the market as institutions ask for them. And so I don't think they'll need to guess at any point because these institutions will directly tell them what they need, and if they don't have it, then they'll find another way to hedge themselves.
And not to be a downer on prediction markets whilst at a prediction markets conference, but if it's true that 70% of the trades are sports bets, is this really moving us towards a riskless society, or is there something else going on? Is this just a microcosm of what we do in the UK on every street corner?
So I think that's very interesting. I am, like personal opinions aside, I don't think that sports markets will help like Delphi's vision of a riskless society, besides maybe certain sports books being able to hedge their own positions. And unfortunately for them, if that gets taken away, they might be the only people affected by that. In terms of the riskless society, like we at Delphi, we consider ourselves the new brokers of risk. So it is our job to educate every single firm on what risks they are exposed to right now. Obviously, you have teams at every big enterprise, every big fund, risk teams, hedging themselves to like commodity risk, FX risk. Event contract risk is something that they like intuitively know, but they haven't been able to express ever. They've been building these portfolios. So as the new brokers of risk, it is our job to educate these people and bring more and more liquidity to these markets that are not sports markets.
We have like 5 more minutes, and I wondered if there was any questions. I can keep asking questions, but given we have you on the stage, people have any questions about Delphi, what they do, this idea of a riskless society? David? I think Mike's coming your way. There's a grey button, you're going to have to push it.
I think markets to avoid it's like a double-edged sword. If I was a trader right now, and I was a trader, the markets that I was trading on was like markets in which I wouldn't recommend institutions to trade on. So like mentions markets, I think there is a lot of alpha in those markets. However, I would never recommend an institution to trade that just because of how volatile and how sort of manipulatable it could be. But I do think if I was a trader right now, that would be the thing that I would focus on because institutions aren't in it, right? So there aren't many sharps in that market right now. But those would be the ones that I would avoid. I can't see a future in which part of our riskless society depends on, what Powell says at his next conference. I don't think that's a future.
So basically trade where institutions aren't trading, seems it. Was there a hand up over here? There's a mic coming your way. You might say your name and what you do. That might be helpful.
My name's Andrew, and I'm working on a prediction market PR. How do you, when you're talking to your institutional clients, it sort of dovetails with the last question, how do you help them quantify settlement risk, particularly as it pertains to potentially getting screwed by, the UMA cabal or, vague or ambiguous wording?
It's great to meet you, Andrew. So in terms of how we help institutions mitigate all those risks naturally on prediction markets, that's part of the job itself, right? That is part of our business model. So right now we have a process in which, let's say we go to a fund or we go to a manufacturing company, we'll identify supply chain risks or portfolio risks. I used to do portfolio risk at a fund myself, and we'll help them first identify their exposures. And usually, it's interesting, 50% of the people we go to, the first step is explaining exactly what a prediction market is. So we can't even pitch ourselves until we explain that. The other 50%, it's more about, okay, are you comfortable hedging on these markets? And a lot of that right now are more of the mainstream markets where there is no settlement risk, there is no niche rules, so it's more of these political markets. As these markets get more and more trusted, then I think you'll see more markets being used to hedge. But right now, it's more of those mainstream markets, or that will help them construct their portfolios to hedge these risks that they naturally have right now.
Right next to you.
Aaron, I'm also good. My question for you is when you're talking to institutional investors, and they go, "I love this, but," what is the but they're looking for? What are the things that haven't been built, that are in the process of being built, and the needs that the prediction market space is not currently meeting that they're saying, we want these solutions to exist?
So when we speak to institutional investors, it's buts first, why you? And that goes right back to our mission. I think a lot of people in the prediction market space don't have an overall vision for how to take these event contracts and move them past 2028, where there's a lot of regulatory risk. In terms of, but what else? Why is there a need for, you have Kalshi, you have Polymarket, who's the next one? Delphi. We're the new brokers of risk. It's our job to educate these firms on prediction markets. Right now, majority of the volume, and as more institutional investors come into Polymarket and Kalshi, you have to go where the money goes, right? And that's in sports market, that's in your combos and your parlays and all of these things. So institutional investors that are already exposed to the prediction market asset class are naturally investors that we're talking to. And so to help them sort of hedge or balance their own exposure to that class is part of hedging the regulatory risk on sports contracts. And that's where we come in, right? We are not sports-related, sports involved, although we do have sports data. That's not part of our vision of a riskless society. So we can almost help them hedge their exposure to the prediction market class as a VC fund by targeting this riskless society.
There was one more question at the back, and I think we've got time for that.
Actually, I had a question. So basically,
Where
how would
are
you...
you?
Here.
Do you want to introduce yourself quickly?
Yeah, so I'm leading Opinion Kings. So I'm the CEO and board of director at Opinion Kings. I just had an interesting question. So how do you see micro markets coming up? So think about people who can create their own markets in the future, but maybe it should be legalized by CFTC. At the same time, it might be able to be regulated in a right way. How do you see those micro markets being created in the future?
Can you explain what a micro market is first? Because I don't actually know.
So I have actually not heard of this terminology, but from my understanding, micro markets are markets like mentions markets where people are speaking, for example.
Yep.
I always find this very funny because I can't imagine these people ask Kalshi or Polymarket to make a market on them.
Yeah.
So naturally, when there's a market created on them, they are now a potential insider on a market that they didn't even know about or want. So I think it's very interesting, like the irony in that.
Yeah.
I don't know how the CFTC is going to handle that in the future. I'm not going to pretend I do, but I just think there's some irony in the fact that these people didn't ask or might not even want markets to be made on their name, and they are already.
Yeah, I mean, if I believe like if it is like we are DCM and DCO and like if we be able to create our markets and like people the traders might be kind of like validate and like post their questions and we have those models inside where risk models inside where we might stabilize those kind of markets. What do you think about it?
I think in that sense, like the question comes down to resolution risk. How is like the governing CFTC going to like manage the resolution risk on markets where they might not even know the participants if it is permissionless? I'm not saying there's not a future in which that could happen, but the risk there is how are you going to resolve these markets?